Indusind Bank, one of India's leading private sector banks, has recently faced a significant stock crash, shaking investor confidence and raising serious concerns about its financial stability. The sudden and sharp decline in its share price has been attributed to multiple factors, including a major accounting discrepancy, governance concerns, and regulatory interventions. The stock has lost nearly 60% of its value from its peak in January last year, with a particularly sharp 27% drop in a single day. This has drawn comparisons to previous banking crises in India, such as the Yes Bank collapse, making it imperative to understand the full scope of the situation. Indusind Bank was founded in 1994 and has since grown into a major player in the Indian banking sector. Known for its strong corporate lending, retail banking, and microfinance operations, the bank has maintained a solid reputation over the years. However, its recent downfall has exposed weaknesses in its internal controls, risk management, and overall governance. The bank's troubles became public when a 1,577 crore rupees accounting discrepancy was discovered in its currency derivatives portfolio. This issue, dating back 8 years, was uncovered after the Reserve Bank of India (RBI) issued a circular prompting banks to review their books. The revelation of this financial irregularity led to panic among investors, triggering a major sell-off. Adding to the uncertainty, the RBI decided to grant the bank's CEO, Sumant Kathpalia, only a 1-year extension instead of the usual 3-year term. This decision raised concerns about the bank's leadership stability and its ability to navigate the crisis. Furthermore, the sudden resignation of the bank's chief financial officer, CFO, further fueled governance concerns. The combination of these events created an atmosphere of distrust, with investors questioning whether more hidden risks might emerge. Given that banks operate on trust and financial integrity, any uncertainty regarding management and regulatory compliance can lead to severe market reactions. Before the crash, Indusind Bank's stock had been performing well, with steady growth in its loan book, strong earnings, and a stable return on equity. However, cracks started to appear when the bank faced rising non-performing assets (NPAs) and exposure to risky corporate loans. The accounting discrepancy was the final trigger, leading to an erosion of investor confidence. When the news broke, the stock plummeted, hitting a new 52-week low of 655 rupees and 95 paise, marking its lowest level since November 2020. The heavy selling pressure indicated that both institutional and retail investors were exiting their positions, fearing further losses. Technical analysis of Indusind Bank's stock reveals a clear downward trend. The stock had been trading in a tight range before the crash, but after breaking key support levels, it entered a free fall zone. The Relative Strength Index (RSI) dropped into the oversold territory, suggesting panic selling. Moving averages indicate that the stock has crossed below its 200-day and 50-day moving averages, a bearish signal that typically suggests prolonged weakness. Market analysts have suggested that unless there is strong positive news or intervention, the stock may continue to remain under pressure in the near term. The Indusind Bank crisis is reminiscent of past banking failures in India, most notably the Yes Bank collapse of 2020. Yes Bank had also expanded aggressively, taking on risky loans that eventually turned into bad debts. When it failed to raise capital and manage its liabilities, the RBI had to intervene, leading to a forced restructuring. Similarly, the Punjab and Maharashtra Cooperative (PMC) bank crisis was caused by undisclosed bad loans, resulting in depositors losing access to their money for an extended period. While Indusind Bank's situation may not be as severe as Yes Bank's, the governance issues and accounting irregularities bear a striking resemblance, raising fears that further negative developments could emerge. Financially, Indusind Bank had been performing well in recent quarters, with consistent growth in net interest income and profitability. However, the accounting discrepancy now raises questions about the accuracy of its past financial reports. Before the crash, the bank's non-performing asset (NPA) ratio had been relatively stable, but investors are now questioning whether more hidden risks exist within its loan book. The bank's capital adequacy ratio and provisioning levels will be crucial in determining its ability to absorb potential losses. If more issues are discovered, the bank may need to raise additional capital to strengthen its balance sheet. The impact of this crisis extends beyond Indusind Bank itself. The Indian banking sector, which has been recovering from past non-performing asset crises, now faces renewed concerns about transparency and regulatory oversight. Other private sector banks have also seen their stocks decline, as investors fear systemic risks. If confidence in private banks is shaken, depositors may shift their funds to public sector banks, altering the competitive landscape. The RBI's role in addressing this issue will be critical, as regulatory intervention may be necessary to restore trust in the banking system. Looking ahead, the bank's future depends on how effectively it manages the crisis. The appointment of an external agency to investigate the accounting discrepancy is a positive step, but the results of this review will be closely watched. If the findings reveal deeper financial troubles, the stock could face further declines. However, if the bank can demonstrate that this was a one-time issue and take corrective actions, investor confidence may gradually return. The role of the RBI in ensuring transparency and stability will be crucial, as regulatory reassurance can help prevent panic-driven decisions. For investors, this crisis serves as a lesson in risk management. Investing in banking stocks requires a thorough understanding of financial health, governance structures, and regulatory risks. The Indusind Bank case highlights the importance of monitoring early warning signs, such as sudden executive resignations, regulatory scrutiny, and accounting irregularities. Diversification remains a key strategy to mitigate risks, as relying too heavily on a single stock or sector can lead to significant losses. In conclusion, the Indusind Bank stock crash is a wake-up call for both investors and regulators. While the full extent of the crisis is still unfolding, the key takeaway is the importance of financial transparency and strong governance in the banking sector. The coming months will determine whether the bank can recover or if deeper structural issues will emerge. For now, caution remains the best approach for those considering investments in the stock. Indusind Bank's stock crash has created a ripple effect across the Indian financial sector, impacting investor sentiment and raising serious questions about risk management in private sector banks. The sudden 27% drop in a single day, coupled with a total decline of nearly 60% from its peak, has led to comparisons with past banking crises. To fully grasp the gravity of the situation, it is essential to analyze not just the immediate causes but also the broader implications for investors, regulators, and the banking industry as a whole. One of the primary reasons for the market's extreme reaction was the 1,577 crore rupees accounting discrepancy in Indusind Bank's currency derivatives portfolio. The issue was not discovered overnight but had been accumulating over the past 8 years. The fact that it only came to light now, after an RBI directive prompted banks to review their books, has raised concerns about the effectiveness of the bank's internal auditing and risk management processes. Investors are particularly worried about whether this discrepancy is an isolated incident or if there could be other undisclosed financial misstatements. The uncertainty surrounding the full extent of the problem has led to a significant loss of confidence. Governance issues have further compounded the crisis. The RBI's decision to grant CEO Sumant Kathpalia only a 1-year extension, instead of the usual 3-year term, was interpreted as a lack of confidence in the bank's leadership. This was followed by the resignation of the Chief Financial Officer, CFO, a move that investors viewed as a potential red flag. When senior executives leave a company amid financial turmoil, it often signals deeper underlying issues. Market participants began to speculate whether more high-profile resignations could follow, adding to the bank's instability. The stock market's reaction has been severe, with Indusind Bank's share price plummeting below its key support levels. Before the crisis, the stock had been trading within a stable range, supported by strong financial results. However, the negative news triggered a free fall, with the stock price breaching its 200-day moving average, a technical indicator that signals long-term weakness. The Relative Strength Index (RSI) dipped well into the oversold territory, suggesting that panic selling was driving the decline. In such situations, recovery can take time, as investors wait for clarity on the bank's financial health before re-entering the market. The Indusind Bank crisis bears similarities to the downfall of Yes Bank, which collapsed in 2020 due to its aggressive lending practices and failure to manage bad loans. Yes Bank had built a reputation as a high-growth bank, attracting significant investor interest. However, when its non-performing assets (NPAs) surged and it failed to raise fresh capital, the RBI had to step in to prevent a complete collapse. A consortium of banks, led by the State Bank of India (SBI), eventually took over Yes Bank to stabilize it. While Indusind Bank's situation is not as extreme, the governance and financial discrepancies have drawn alarming parallels. Investors fear that if the crisis deepens, the RBI might have to intervene more directly. Another relevant comparison is the Punjab and Maharashtra Cooperative (PMC) bank crisis, which was caused by the bank's excessive exposure to a single real estate borrower, HDIL. The bank had hidden bad loans, leading to its eventual collapse. The key lesson from the PNC Bank scandal was the importance of transparency in banking operations. While Indusind Bank is a much larger and more systematically important institution, the common thread in these banking failures is the erosion of trust due to financial mismanagement. Before the crash, Indusind Bank had been reporting stable financial performance. Its net interest income, a key measure of profitability, had been growing consistently, and its return on assets (ROA) was within industry benchmarks. However, the sudden revelation of an accounting discrepancy casts doubt on the reliability of past financial statements. Investors are now closely scrutinizing the bank's non-performing asset (NPA) ratio, which had been reported at manageable levels. If further hidden losses emerge, the bank may have to increase its provisions, putting additional strain on its profitability. The banking sector as a whole has been impacted by Indusind Bank's troubles. Other private sector banks, including Axis Bank, ACC Bank, and HDFC Bank, saw their stock prices decline in response to the news. While these banks are not directly linked to Indusind Bank's financial issues, investor sentiment tends to react negatively to uncertainty in the banking sector. This is because banks are interconnected through lending, deposits, and market exposure. If one bank faces a crisis, it can create a domino effect, causing investors to reassess risks across the sector. For depositors, the immediate concern is the safety of their funds. While Indusind Bank remains operational and well capitalized, the crisis has led to speculation about a potential loss of depositor confidence. If large depositors withdraw funds out of fear, it could create a liquidity crunch for the bank. However, unlike Yes Bank or PNC Bank, Indusind Bank has not faced any restrictions from the RBI, which suggests that its liquidity position is still stable. The future outlook for Indusind Bank depends on several factors. First, the bank must complete a thorough investigation into the accounting discrepancy and provide a clear explanation to investors. If the issue is found to be a one-time error rather than systemic fraud, investor confidence could be restored over time. Second, the RBI's stance will be crucial. If the central bank expresses confidence in the bank's ability to recover, it could help stabilize the stock price. Third, the bank's ability to maintain strong earnings in the coming quarters will determine how quickly it can recover from the crisis. From an investment perspective, this crisis serves as an important lesson in risk management. Banking stocks, while often considered safe, are highly sensitive to governance and regulatory risks. Investors must look beyond financial statements and assess qualitative factors, such as leadership stability and corporate governance. The Indusind Bank crisis highlights the importance of diversification. Investors who were overly concentrated in the stock have suffered significant losses, whereas those with a diversified portfolio have been able to absorb the shock more effectively. Market analysts remain divided on whether Indusind Bank stock is a buying opportunity or a value trap. Some believe that the worst may be over and that the stock could recover once clarity emerges. Others caution that further negative surprises could still surface, making it risky to invest at this stage. Typically, banking crises unfold over months rather than days, meaning that investors should wait for more information before making long-term decisions. Regulators are also likely to take lessons from this crisis. The RBI has been tightening its oversight of private banks in recent years, particularly after the Yes Bank collapse. The Indusind Bank issue reinforces the need for stricter auditing standards and more proactive intervention when early warning signs appear. One potential outcome of this crisis could be stronger regulations requiring banks to disclose financial discrepancies more transparently. Indusind Bank's ability to recover will depend largely on whether it can regain investor trust. Transparency, strong leadership, and regulatory support will be key factors in determining its future trajectory. The banking industry operates on confidence, and once trust is lost, it takes time to rebuild. For now, caution remains the best approach for investors, as the full impact of this crisis is yet to unfold. The broader lesson from this crisis is that financial stability cannot be taken for granted. Even well-established banks can face sudden challenges if risk management is not handled effectively. The role of regulators, auditors, and investors in ensuring transparency is more critical than ever. As the financial world watches how Indusind Bank navigates this crisis, the key takeaway is clear: trust is the most valuable currency in banking, and once it is shaken, recovery becomes an uphill battle. Indusind Bank's path to recovery will not be straightforward. Investor sentiment has taken a major hit, and rebuilding confidence will take time. The bank will have to demonstrate that it can effectively manage risks and prevent similar issues from arising in the future. The first step in this process is a thorough and transparent investigation into the 1,577 crore rupees accounting discrepancy. Investors and regulators alike will be closely watching the bank's response, and any attempt to downplay or delay the findings could further erode trust. One of the biggest risks the bank faces is a potential downgrade by credit rating agencies. Rating agencies such as CRISIL, Moody's, and Fitch assess the financial health of banks based on various factors, including asset quality, governance, and risk management. If they perceive Indusind Bank as a high-risk entity due to poor governance or financial mismanagement, they could downgrade its rating. This would increase the bank's borrowing costs, making it more expensive to raise funds in the future. A downgrade could also lead institutional investors, such as mutual funds and pension funds, to reduce their holdings in the bank's stock and bonds, leading to further pressure on its share price. Another key factor influencing the bank's future is customer behavior. While retail depositors may not withdraw their money immediately, large corporate depositors and high-net-worth individuals may consider moving their funds to more stable banks. If a significant number of large depositors withdraw funds, the bank's liquidity position could weaken, making it difficult to meet its short-term obligations. The RBI will be monitoring deposit flows closely to ensure that there is no panic among customers. The response of foreign institutional investors, FIIs, will also be crucial. FIIs hold a significant stake in Indian banking stocks, and their reaction to the crisis could determine the stock's near-term movement. If FIIs decide to sell their holdings due to concerns over governance and financial mismanagement, the stock could face additional downward pressure. On the other hand, if the bank can provide a clear and satisfactory explanation of the accounting discrepancy, some long-term investors might see the current dip as a buying opportunity. The broader banking sector will also feel the effects of this crisis. When a major bank like Indusind Bank faces financial instability, it raises concerns about the overall health of private sector banks. This could lead to stricter regulatory oversight for the entire banking industry, with the RBI potentially introducing new disclosure requirements and stress testing measures to prevent similar incidents. Other banks may also face increased scrutiny regarding their own financial reporting practices, which could impact their stock prices. Historically, banking crises have shown that recovery depends not only on financial strength but also on leadership stability. If Indusind Bank can demonstrate strong governance reforms, reinforce investor confidence, and maintain robust earnings in the coming quarters, its stock could stabilize. However, if further governance issues or financial irregularities emerge, the situation could deteriorate further, leading to a prolonged period of weakness for the bank. In the coming months, the bank's quarterly earnings reports will be critical in determining the direction of the stock. Investors will be closely analyzing key metrics such as net interest margin, NIM, loan growth, and asset quality. Any significant deterioration in these indicators could signal deeper issues and lead to further stock price declines. Conversely, if the bank manages to maintain stable earnings and improve transparency, the stock could gradually recover. One possible scenario is that the RBI might impose corrective measures to strengthen the bank's risk management framework. In past banking crises, regulators have stepped in to ensure stability and prevent contagion to the broader financial system. If the RBI sees systemic risks in Indusind Bank's current situation, it may require the bank to improve its internal controls, strengthen its board of directors, or even appoint an external monitoring committee. Investors who are considering buying the stock at current levels should be cautious. While the stock's steep decline makes it appear attractive from a valuation perspective, the risk of further negative surprises remains high. It is often tempting to buy a stock after a crash, hoping for a quick rebound, but banking crises typically take time to resolve. Many investors who bought Yes Bank during its decline ended up facing prolonged losses as the stock continued to struggle for years. At this point, the most prudent approach for investors is to wait for more clarity. Indusind Bank's management needs to provide a comprehensive plan on how it intends to address the accounting discrepancy, restore investor confidence, and strengthen governance practices. Until these issues are resolved, the stock is likely to remain volatile. For the broader banking industry, this crisis serves as a wake-up call. Strong governance, risk management, and transparency are essential for maintaining investor trust. The RBI and SEBI may introduce new regulatory measures to ensure that private sector banks adhere to stricter financial reporting standards. Such reforms, while initially challenging for banks, would ultimately lead to a more resilient financial system. In conclusion, Indusind Bank's stock crash has sent shockwaves through the financial markets, raising concerns about governance, financial transparency, and regulatory oversight. The coming weeks and months will be critical in determining the bank's future trajectory. If the bank can effectively address the concerns raised by investors and regulators, it has the potential to recover over time. However, if further financial mismanagement is uncovered, the crisis could deepen, leading to more severe consequences. Investors should tread carefully, keeping a close watch on developments before making any investment decisions. The ripple effects of Indusind Bank's crash also extend beyond immediate stock market concerns, influencing investor psychology, the regulatory landscape, and broader market stability. In the aftermath of such a significant drop in the bank's share price, the market will likely undergo a period of recalibration, where risk appetite and perceptions of private sector banks' stability are reconsidered. One critical consequence of this crisis is the loss of investor trust in financial institutions. Trust is the foundation of the banking sector. Without it, even the most well-capitalized banks struggle to attract investments and maintain smooth operations. In the case of Indusind Bank, the revelation of hidden discrepancies and the leadership turmoil that followed created a perception of instability. Investors who previously considered Indusind Bank to be a reliable financial institution may now be cautious of any potential exposure to similar risks in other private banks. The market will now likely demand more transparency and tighter regulations for risk management. The financial sector, particularly in emerging markets like India, has traditionally relied on strong investor sentiment for capital infusion, expansion, and day-to-day operations. A loss of confidence, even temporarily, can create liquidity issues, as investors may pull out their investments or reduce their exposure to private sector banks. The crisis at Indusind Bank highlights that even banks with otherwise strong fundamentals may be vulnerable to unforeseen risks, and this reality will weigh heavily on future investor behavior. On the regulatory front, the RBI and other financial regulators will undoubtedly be under pressure to act swiftly and decisively to restore confidence in the banking system. The Indian banking sector has seen significant changes in governance standards in recent years, and while Indusind Bank's issues may appear to be an isolated case, they could push regulators to introduce stricter measures to prevent similar issues from arising at other banks. The RBI may consider mandating more frequent audits or introducing more stringent disclosures regarding risk exposure, particularly in the realm of derivatives and currency trading. These steps are essential to reinforce investor trust and ensure that the banking system remains resilient in the face of global economic volatility. Given the international focus on India's financial markets, the regulatory response could also have broader implications for foreign investor perceptions. Global investors who previously viewed India as a growing, dynamic market could begin to question the stability of the financial system if such issues remain unresolved. The role of foreign institutional investors, FIIs, is particularly crucial, as they account for a significant portion of the capital inflows into India's banking sector. A mass exodus of FIIs from Indian banks could result in higher borrowing costs for the country and hamper economic growth. In this context, the RBI's ability to navigate this crisis and rebuild confidence in the Indian banking system will be closely monitored by international investors. The stock market itself has shown the vulnerability of financial stocks to external shocks. A steep drop in the share price of a major player like Indusind Bank reverberates across the broader market. Other banks in the private sector space, such as HDFC Bank, Axis Bank, and ICICI Bank, might experience a dip in their stock prices due to the ripple effects of Indusind Bank's problems. While these banks may not be directly affected by Indusind Bank's financial issues, the market's reaction to one bank's crisis often spills over to others. This can lead to a temporary decline in the value of financial stocks across the board, even for companies that have no direct involvement in the crisis. For the wider Indian economy, this crisis could also lead to increased uncertainty, especially among retail investors. Banks serve as a backbone for economic activity, and disruptions in their operations can have a trickle-down effect on businesses and consumers. When investors pull out of the banking sector, it becomes harder for banks to raise capital, potentially leading to tighter lending conditions. This, in turn, could affect the availability of credit for businesses and consumers, which could slow down economic growth. Additionally, as banks focus more on repairing their balance sheets and stabilizing their operations, their appetite for lending may be reduced, further restricting economic expansion. However, there are some potential silver linings in the wake of this crisis. If Indusind Bank can effectively weather the storm and demonstrate that it has the ability to manage risk and restore its governance practices, it may come out of the situation stronger. The bank could implement structural reforms, improve internal controls, and recalibrate its risk management systems, which would help it regain investor confidence. The process of recovery may take time, but if the bank can prove its resilience, it could eventually emerge from this crisis as a more robust institution, better equipped to navigate future challenges. This crisis also provides a valuable learning opportunity for other banks in the private sector. Many of them may now reassess their own risk management practices, particularly with regard to currency derivatives and foreign exchange exposures. Indusind Bank's accounting discrepancy raises important questions about how banks are managing their portfolios and whether their financial statements accurately reflect their true risk exposures. Other banks, in turn, may be more cautious in their approach to derivatives trading and other complex financial products to avoid finding themselves in similar predicaments. Moreover, financial institutions may start focusing more on bolstering their corporate governance practices to restore trust with investors. Indusind Bank's leadership turmoil, with the resignation of key executives and the short extension of CEO Sumant Kathpalia's term, has underlined the importance of stable and effective leadership in maintaining investor confidence. Banks that prioritize clear communication, transparency, and strong leadership could attract the trust of investors more quickly. For retail investors, the Indusind Bank crisis highlights the importance of diversification and risk assessment when investing in the stock market. The rapid decline in Indusind Bank's stock price shows that no stock, no matter how promising it seems, is immune to sudden shocks. Investors who had a large portion of their portfolio invested in Indusind Bank may have suffered significant losses. This reinforces the value of diversification, spreading investments across different sectors and asset classes to minimize the impact of any single investment's poor performance. Indusind Bank's shareholders are likely to experience volatility in the coming months. Although there may be a short-term rebound as the market digests the news and the bank works to restore its stability, the long-term outlook for the stock is still uncertain. Investors may consider waiting for more clarity from the bank's management regarding the accounting discrepancies, governance issues, and overall recovery plan. A well-executed recovery strategy could lead to the stock price stabilizing and eventually regaining some of the lost ground. The Indusind Bank debacle is a stark reminder of the importance of robust financial practices, regulatory oversight, and sound leadership in ensuring the stability of the banking system. While the crisis has shaken investor confidence, it also presents an opportunity for banks and regulators to learn and improve. The Indian banking sector has weathered storms in the past and will likely emerge stronger from this experience, but the road to recovery will require time, transparency, and a renewed focus on trust building. As investors, regulators, and banks reflect on this crisis, the lesson is clear: stability in the banking sector is fragile, and even well-established institutions can falter if risk management and governance are not diligently prioritized. Indusind Bank's recovery will serve as a case study for the entire sector on how to navigate and rebuild after a financial crisis, and it will set the stage for how private sector banks in India adapt to the growing need for more rigorous financial controls and transparent reporting. While the crisis surrounding Indusind Bank has raised several important issues regarding governance, risk management, and investor sentiment, it also offers a broader perspective on the challenges and opportunities within the Indian banking industry. The consequences of this situation are not confined solely to the bank in question but also have far-reaching implications for how the industry will evolve in the future. The Indusind Bank episode underscores the volatility inherent in the financial markets and serves as a reminder of the significance of maintaining strong internal controls, regulatory compliance, and ethical leadership. The crisis will likely accelerate the need for increased regulatory scrutiny and more stringent norms for private sector banks. While the Reserve Bank of India (RBI) has historically been seen as a proactive regulator, this event could lead to calls for even stricter oversight. The RBI, along with the Securities and Exchange Board of India (SEBI), may introduce new regulations that impose greater transparency in financial reporting, especially regarding complex financial instruments such as derivatives and foreign exchange positions. These measures would aim to prevent similar issues from cropping up in the future, improving the overall health of the banking sector and minimizing risks associated with financial mismanagement. In addition to regulatory changes, there may also be a shift in investor behavior. Investors are now more likely to demand comprehensive due diligence and transparency when evaluating financial institutions. While it may be tempting to focus only on the short-term performance of a bank, the Indusind Bank crisis has shown that long-term stability requires strong governance, effective risk management strategies, and the ability to react swiftly to any irregularities. As a result, investors will increasingly value banks with a clear commitment to corporate governance, internal controls, and ethical business practices. Furthermore, Indusind Bank's experience highlights the growing importance of digital and technological tools in managing risk and increasing operational efficiency. Many of the challenges faced by the bank could have been mitigated if more advanced risk management software had been employed, particularly for monitoring derivatives and currency-related exposures. Banks that fail to adopt cutting-edge technology in their operations risk falling behind in an increasingly digital world. Financial technology, or fintech, is a sector that has seen explosive growth, and its integration with traditional banking could become a critical factor in restoring public trust and stabilizing the financial system. The adoption of AI and machine learning technologies to identify and manage financial risks could greatly enhance the resilience of banks, reducing the potential for accounting discrepancies and improving predictive capabilities. The Indusind Bank crisis could also lead to a shift in how banks interact with their customers, particularly in terms of communication. Transparency and clarity in messaging are essential for maintaining customer trust, especially during turbulent times. Customers are likely to be more cautious when dealing with banks that have been involved in scandals or financial discrepancies, and they may expect better communication on how their funds are being managed. Banks may need to invest in better customer engagement strategies and improve their internal communication frameworks to ensure that stakeholders are always aware of the bank's financial health and stability. One of the key takeaways from this crisis is the importance of maintaining a healthy balance between aggressive growth strategies and risk management practices. Indusind Bank, like many others in the private sector, has historically pursued an expansionist model, seeking to increase its market share rapidly. While aggressive growth can be an effective strategy in the right conditions, it must be accompanied by robust risk management protocols. When a bank grows too quickly without adequately assessing the risks involved, it exposes itself to the possibility of financial irregularities and operational missteps. Therefore, future growth strategies should prioritize sustainability, ensuring that the necessary risk controls are in place to manage potential pitfalls. The impact on Indusind Bank's employees will also be significant. Any ongoing financial crisis within a company inevitably leads to uncertainty among its staff, with employees worried about job security and the future of the organization. In the case of a bank, this uncertainty can also have a ripple effect on the broader economy. Employees in key areas such as lending, risk management, and compliance may be affected, as the bank will need to restructure or realign resources to focus on crisis management and recovery. Moreover, in such a scenario, the morale of employees can be severely impacted, leading to lower productivity and even the loss of talent. Indusind Bank will need to provide clear communication to its employees about its recovery plans to ensure retention and maintain organizational stability. Another area of concern for Indusind Bank is its reputation in the market. Banking, more than many other industries, relies heavily on reputation. A bank's reputation can be built over decades but can be destroyed in a short time due to mismanagement, financial discrepancies, or governance issues. Regaining a positive reputation is a long and arduous process, and Indusind Bank will need to focus not only on stabilizing its financials but also on its public image. Effective reputation management strategies could include media outreach, customer service improvements, and the promotion of positive news stories about the bank's recovery efforts. The bank will need to demonstrate that it is committed to high ethical standards, and its actions in the coming months will be crucial in regaining public trust. At the same time, the crisis at Indusind Bank might open the door for new competitors in the market. The Indian banking industry is vast and diverse, with a growing number of digital and challenger banks seeking to disrupt the traditional banking model. These new players, many of whom are technologically advanced and agile, could be positioned to take advantage of Indusind Bank's challenges. If the bank is unable to recover quickly and address its internal problems, it may lose customers to these emerging competitors who are able to offer more attractive products or services. As competition increases, banks like Indusind Bank will need to focus on enhancing their customer offerings, improving service quality, and providing innovative products that differentiate them from new entrants. This is especially true as the financial services landscape becomes increasingly digitized. To remain relevant in the future, traditional banks must adopt fintech solutions that enable them to offer seamless digital banking experiences, including mobile payments, online loan processing, and real-time customer support. In the context of the Indian economy, the crisis is a stark reminder of the challenges faced by banks operating in emerging markets. India has seen significant growth in recent years, with rising incomes, increasing consumption, and a growing middle class. However, the financial services sector in India is still maturing, and risks related to governance, operational transparency, and financial stability remain present. Indusind Bank's situation serves as a reminder that India's financial institutions must be held to high standards of corporate governance, and that robust regulatory frameworks are crucial in ensuring stability during periods of economic growth. As India moves toward a more digitized economy, ensuring financial stability in the banking sector will be paramount. Banks must adapt to new regulatory standards, implement robust governance measures, and embrace technological innovations to minimize risks and manage uncertainties. Regulatory bodies like the RBI will need to provide leadership and oversight to guide the sector through these challenges, ensuring that the banking system remains resilient and continues to support economic growth. In conclusion, the crisis at Indusind Bank is a multifaceted issue that involves governance failures, financial mismanagement, and a loss of investor confidence. While the immediate effects are damaging to the bank's stock price and reputation, the long-term outcomes depend on the bank's ability to recover, restore trust, and rebuild its operations. The broader Indian banking sector will likely undergo significant changes in response to this crisis, with stricter regulations, enhanced transparency, and a shift toward digitalization being key trends in the coming years. For investors, it is crucial to stay vigilant and assess the risk-reward profile of banks like Indusind Bank as they navigate this challenging period. With appropriate reforms, robust governance, and effective crisis management, Indusind Bank can recover and emerge stronger, but only if it takes decisive action to address the issues at hand. As Indusind Bank works toward its recovery, a crucial aspect of its journey will be the restoration of stakeholder trust. The credibility of any financial institution is primarily built on trust, and once it's eroded, it becomes a lengthy process to rebuild. To regain investor confidence, the bank must not only stabilize its financial position but also demonstrate a clear commitment to transparency, ethical business practices, and responsible lending. This involves not only fixing the immediate financial issues but also creating a long-term strategy focused on solid governance structures and rigorous oversight mechanisms. The bank's leadership will play a pivotal role in this rebuilding process. The board and top management must be held accountable for the governance failures that allowed the crisis to unfold, and a change in leadership could be one of the most effective ways to signal that the organization is committed to making changes. Effective leadership will be critical in steering the organization through the crisis, providing clarity on the bank's recovery plan, and working closely with regulatory bodies and investors to ensure that the appropriate corrective actions are taken. Moreover, restoring customer trust will require more than just financial measures. Indusind Bank must focus on customer-centric approaches to regain market position. This includes offering personalized banking experiences, competitive interest rates, innovative product offerings, and enhanced customer service. It's essential to demonstrate that the bank has learned from past mistakes and is actively working toward providing a more secure, transparent, and customer-friendly environment. The role of technology will be another significant factor in Indusind Bank's recovery strategy. As the banking industry undergoes a digital transformation, leveraging technological solutions to drive operational efficiencies and improve customer service will be key. The integration of advanced data analytics, artificial intelligence (AI), and machine learning can help the bank monitor transactions in real time, detect fraud, and make smarter lending decisions. Furthermore, these technologies can enhance customer experience through tailored offerings and predictive services, enabling the bank to not only recover but also differentiate itself in an increasingly competitive market. Indusind Bank will also need to address its risk management frameworks. A review of its existing systems and practices in managing credit, market, and operational risks is necessary. This could involve bringing in external experts to assess its risk models and recommending improvements. Given the highly interconnected nature of global financial markets, especially after the pandemic, banks are more vulnerable to external shocks than ever before. Strengthening risk management systems and implementing robust scenario-based testing can help prepare the bank for future economic fluctuations and minimize the impact of external factors on its performance. In the broader context of India's financial system, the crisis at Indusind Bank also serves as a reminder of the vulnerabilities faced by private sector banks, particularly those that have expanded rapidly. These banks often operate in a more competitive environment, where profit growth is prioritized, and such pressure can sometimes lead to reckless decision-making or mismanagement. While private banks in India have been a significant part of the country's banking sector, this incident highlights the necessity of balancing growth with prudent financial practices. Banks must ensure that their expansion strategies are supported by solid risk management frameworks, regulatory compliance, and strong internal controls. The Indian financial system is also at a critical juncture, where fintech companies are increasingly competing with traditional banks for market share. As digital finance becomes more mainstream, these fintech players are offering a wide range of services that challenge the traditional banking model. For example, digital wallets, peer-to-peer lending, and blockchain-based banking solutions are disrupting the sector by providing cheaper, more efficient alternatives to traditional banking services. Indusind Bank, and others in the industry, will need to adapt to these changing dynamics by embracing digitalization and providing innovative financial products that resonate with the younger, tech-savvy demographic. This crisis has also highlighted the importance of effective corporate governance, particularly in private sector banks. The governance model needs to be strengthened to ensure that any potential risks, whether financial, operational, or reputational, are identified early and addressed promptly. The RBI and other regulators will likely use this situation as a case study to enhance their oversight mechanisms, setting higher standards for corporate governance in Indian banks. This could include stricter norms on internal audits, transparency in financial reporting, and accountability at all levels of management. The crisis will also have ripple effects on the Indian stock market and investor behavior. In the short term, stocks of affected banks, including Indusind Bank, may continue to face downward pressure as investors digest the implications of the situation. However, in the long run, this event could create opportunities for those who have the foresight to invest in banks that are well managed and have a clear vision for the future. While Indusind Bank's stock price has seen a decline due to the crisis, it may recover over time if it implements a sound recovery strategy and restores stakeholder confidence. From a regulatory perspective, the Indian government and financial institutions will likely focus on strengthening the country's banking sector. The RBI, SEBI, and other regulatory bodies may introduce reforms to enhance transparency, improve disclosure practices, and ensure better risk management systems in banks. These reforms could help make the sector more resilient to future shocks, both domestic and global. One of the key lessons from this crisis is that the financial health of banks is inextricably linked to the overall stability of the economy, and proactive measures need to be taken to address potential risks before they spiral out of control. In the broader Indian economy, the Indusind Bank crisis also casts a shadow over the financial inclusion efforts. As a growing number of Indians enter the banking system, access to credit and financial services has become increasingly important for driving economic growth. The actions taken by banks in response to this crisis will be critical in ensuring that the banking sector remains inclusive and accessible to all segments of society, particularly in rural and underserved regions. Any financial instability in major banks could limit access to credit, slowing down the economic recovery and hurting businesses, especially small and medium-sized enterprises (SMEs). The situation also raises questions about the role of credit rating agencies and their ability to assess the true financial health of banks. Rating agencies are often relied upon by investors to provide insights into the financial strength of institutions. In the case of Indusind Bank, its rating could have influenced investor perception and decisions, and any misjudgment in assessing the bank's risks could have contributed to the severity of the crisis. In the future, there may be calls for greater scrutiny of rating agencies, methodologies, and more transparency in their assessments. On a societal level, the Indusind Bank crisis has brought to light the importance of financial literacy among the general public. While investors and institutional stakeholders may have a strong understanding of banking operations, the average consumer is often less equipped to understand the complexities of financial systems. Financial literacy programs that educate consumers about banking products, risks, and governance structures could help mitigate the impact of such crises in the future. These programs would also empower individuals to make more informed decisions about their investments, savings, and financial well-being. As Indusind Bank works to address the fallout from this crisis, it is important for the bank to not only focus on short-term recovery but also plan for long-term growth and stability. Strategic partnerships, investment in technology, and a renewed focus on customer service can help the bank regain its footing and strengthen its position in the market. Furthermore, the crisis provides an opportunity for other banks to assess their own risk management frameworks and governance structures, ensuring that they are better prepared to handle challenges in the future. Ultimately, the crisis at Indusind Bank offers several valuable lessons for the Indian banking industry. It serves as a reminder that growth and profitability should not come at the cost of sound governance and risk management. It also highlights the need for a more transparent, customer-centric, and technologically advanced banking environment, where the interests of all stakeholders, investors, customers, employees, and regulators, are taken into account. By learning from the mistakes of this crisis and implementing reforms, Indian banks can ensure that they are better equipped to handle future challenges and contribute to the continued growth and stability of the Indian economy. As the situation unfolds, the steps taken by Indusind Bank to resolve its crisis and restore stakeholder confidence will be closely monitored by both the public and the financial markets. The recovery of the bank may take time, but with the right combination of governance reforms, financial discipline, and customer-centric strategies, it can emerge stronger and more resilient. As the Indusind Bank crisis continues to unfold, the need for broader systemic reforms in the Indian banking sector becomes even more pressing. One of the primary concerns that has emerged from this situation is the need for a more robust regulatory framework that can prevent such crises from occurring in the first place. While the Reserve Bank of India (RBI) has historically played a crucial role in regulating the banking sector, the scale of the challenges faced by banks like Indusind highlights that there may be a need for more proactive oversight and intervention. Moving forward, the RBI is likely to implement more stringent regulations, particularly in areas like corporate governance, risk management, and transparency. It is clear that effective regulation can act as a safeguard against mismanagement and financial instability. By enforcing tighter regulations and increasing transparency, the RBI can ensure that banks are more accountable for their actions and decisions, preventing them from taking excessive risks that could jeopardize the financial system. This could also involve more frequent audits and assessments of financial institutions, enabling regulators to identify any emerging risks early and take corrective actions before they escalate into full-blown crises. Additionally, there may be increased focus on strengthening the banking sector's resilience to external shocks. India's financial markets are increasingly connected to the global economy, and the ripple effects of global economic downturns or financial crises can have severe consequences for domestic banks. To mitigate these risks, the RBI may introduce stress testing measures that evaluate how banks would fare under various economic scenarios, such as a recession or a major market disruption. These stress tests could provide valuable insights into the vulnerability of individual banks and help regulators take preventive measures to safeguard financial stability. Another crucial area of reform will be improving the banking sector's risk management practices. The rapid expansion of private sector banks like Indusind has led to a greater exposure to credit risk, operational risk, and liquidity risk. The bank's lending policies and its exposure to specific sectors or geographic regions may have played a significant role in the current crisis. To address this, the RBI may require banks to adopt more comprehensive risk management frameworks, which include better risk assessment tools, more stringent lending criteria, and contingency planning for potential financial crises. For Indusind Bank, regaining customer and investor trust will require a multifaceted approach. One of the key steps in this recovery process will be to re-establish its reputation for reliability and stability. Customers who were once loyal to the bank may now be hesitant to continue their business with the institution, particularly if they feel that their savings or investments are at risk. To reassure these customers, Indusind Bank will need to focus on rebuilding its relationships through enhanced customer service and clear communication. Providing regular updates on the bank's recovery plan, showcasing improvements in operational efficiency, and offering more personalized banking products could go a long way in winning back customer loyalty. Indusind Bank must also work diligently to improve its internal controls and governance structures. Strengthening its internal audit functions, ensuring that all financial transactions are thoroughly reviewed and scrutinized, and improving oversight on key decision-making processes will help prevent any future governance failures. Moreover, the bank may consider establishing an independent risk management committee that includes external experts with specialized knowledge in financial risk and corporate governance. This could provide an additional layer of oversight and ensure that any risks to the bank's financial health are identified and mitigated early. The role of corporate governance will be crucial in preventing future crises. In the aftermath of this incident, there may be increased scrutiny of the bank's board of directors, executive leadership, and their ability to effectively steer the institution. If the crisis is found to have been the result of poor governance or a lack of accountability, there could be calls for changes in the leadership structure. Investors and customers alike will be looking for transparency and decisive leadership, and the bank's board will need to show a clear commitment to reforming the institution's governance practices. This may involve bringing in new leadership or adopting a more stringent code of ethics for top executives. In addition to governance reforms, the bank will need to address its operational weaknesses. For example, the bank may need to modernize its IT infrastructure and integrate more advanced technologies to improve efficiency and reduce costs. The use of artificial intelligence, data analytics, and automation could help streamline operations, enhance fraud detection, and provide a more personalized experience for customers. Digital transformation has become a key priority for banks globally, and Indusind Bank must leverage technology to stay competitive and meet evolving customer expectations. On a macroeconomic level, the crisis at Indusind Bank could prompt policymakers to rethink the role of private sector banks in the Indian economy. Historically, public sector banks have been viewed as the backbone of India's banking system, and private banks like Indusind have often been seen as more nimble and innovative. However, this crisis has highlighted the risks associated with the rapid growth of private sector banks and the potential for governance failures in the absence of robust regulatory oversight. Moving forward, there may be a greater emphasis on balancing the growth ambitions of private banks with the need for prudent financial practices and strong corporate governance. From an investor perspective, the current crisis presents an opportunity to assess the long-term prospects of Indusind Bank and similar institutions. While the stock price may be volatile in the short term, investors with a long-term horizon may see potential in the bank's recovery plan and the broader banking sector's prospects. The crisis could lead to a restructuring of the bank's operations, making it a leaner and more efficient institution in the future. However, investors will need to weigh the risks involved and consider the potential for further regulatory scrutiny and market volatility before making investment decisions. Moreover, the incident at Indusind Bank has implications for financial inclusion in India. Over the years, India has made significant progress in expanding access to banking services, particularly in rural and underserved areas. However, the crisis could undermine some of this progress, as customers may become more wary of entrusting their money to banks. To ensure that financial inclusion efforts continue unabated, it will be essential for the banking sector, including both public and private banks, to rebuild trust with consumers and continue offering products and services that cater to the needs of India's diverse population. Ensuring that small businesses, farmers, and low-income households have access to affordable credit and banking services will be critical for supporting India's economic growth and development. At the same time, the crisis has highlighted the need for greater financial literacy among the general public. Many retail investors and customers may not fully understand the risks associated with banking or investment products, which can lead to poor decision-making during times of uncertainty. Financial literacy programs that educate individuals about basic banking practices, investment strategies, and the importance of diversification could help mitigate the impact of such crises and empower consumers to make more informed financial decisions. The crisis at Indusind Bank also presents an opportunity for other players in the financial ecosystem, such as fintech companies and digital banks, to step up and offer alternative banking services. As consumers increasingly embrace digital solutions for managing their finances, there may be a growing demand for innovative and transparent banking products. Fintech startups that provide services like peer-to-peer lending, digital wallets, and blockchain-based solutions could benefit from the market disruption caused by the Indusind Bank crisis. By focusing on customer-centric offerings and leveraging advanced technology, these fintech companies could capture a larger share of the market and challenge traditional banks in the process. Ultimately, the Indusind Bank crisis is a complex issue that will require a multi-dimensional approach to address. The immediate focus must be on stabilizing the bank's financial position, restoring stakeholder trust, and implementing reforms to prevent future governance failures. In the long term, this crisis presents an opportunity for the Indian banking sector as a whole to evolve and improve its practices. By embracing stronger regulatory oversight, better risk management, and a more customer-focused approach, Indusind Bank and its peers can emerge from this crisis stronger and more resilient. To ensure that this recovery process is sustainable and long-term, the bank must also consider the importance of diversifying its revenue streams. Historically, Indusind Bank has been heavily reliant on traditional banking products such as loans, mortgages, and deposits. While these services remain crucial, they also come with inherent risks, particularly in times of economic downturns or when the bank faces liquidity challenges. Diversification can help spread risk and create more stable revenue sources. For example, Indusind Bank could explore expanding into asset management, insurance, or wealth management services. These businesses typically offer higher margins than traditional banking products and can provide a cushion during times of financial instability. By building a more diversified portfolio, the bank could reduce its reliance on the performance of individual sectors or loan portfolios, thus stabilizing its revenue generation. At the same time, the bank will need to reassess its exposure to high-risk sectors or markets that may have contributed to its financial troubles. While it is important for banks to take on some level of risk in order to generate profits, there needs to be a careful balance between risk-taking and ensuring that the bank is adequately capitalized to absorb potential losses. By focusing on more secure, long-term investments and diversifying its loan portfolio, Indusind Bank can reduce its vulnerability to sudden economic shocks or sector-specific downturns. Another crucial aspect of the bank's recovery will be its focus on technology and digital innovation. As consumers increasingly demand seamless and efficient banking experiences, it will be essential for Indusind Bank to stay ahead of technological trends and leverage digital tools to improve its services. One potential area for innovation is artificial intelligence (AI), which has the potential to revolutionize various aspects of banking, from customer service to fraud detection and credit risk assessment. By adopting AI-driven solutions, Indusind Bank can enhance its ability to personalize customer interactions, streamline internal processes, and detect fraudulent activities more efficiently. Machine learning algorithms can also be used to identify potential credit risks and market trends, helping the bank make more informed lending decisions and reducing its exposure to defaults. Furthermore, the bank can use AI to automate routine tasks, such as processing loan applications, which would improve operational efficiency and lower costs. The bank should also prioritize improving its mobile banking and digital platforms. In recent years, the demand for mobile banking services has surged as more customers opt for the convenience of banking on the go. With an increasing number of people using smartphones and other digital devices for financial transactions, offering an intuitive and feature-rich mobile app will be essential for retaining and attracting customers. Features such as easy fund transfers, bill payments, loan applications, and personal finance management tools can significantly enhance the customer experience and foster greater engagement. Furthermore, cybersecurity will need to be a top priority for Indusind Bank as it invests in technology. The increasing reliance on digital channels for banking transactions has made financial institutions prime targets for cyberattacks. As data breaches, ransomware attacks, and identity theft become more common, banks must implement robust cybersecurity measures to protect sensitive customer information and prevent financial losses. Indusind Bank must continuously upgrade its security protocols, conduct regular security audits, and ensure that it complies with the latest data protection regulations. In addition to technology, the bank will need to invest in its human resources. A skilled, motivated workforce is critical to ensuring that the bank is able to effectively navigate the challenges posed by the current crisis. As part of its recovery efforts, Indusind Bank should focus on talent acquisition, training, and retention. By attracting experienced professionals and offering continuous training opportunities for existing employees, the bank can strengthen its internal capabilities and position itself for future growth. Moreover, a focus on leadership development will ensure that the bank's senior management is equipped to make informed and strategic decisions that will drive long-term success. The role of investors and shareholders will also be vital in the bank's recovery. Indusind Bank will need to communicate clearly and regularly with its investors to ensure transparency and maintain confidence in its ability to recover. It is likely that shareholders will push for accountability from the bank's management, particularly if the crisis is tied to governance failures or mismanagement. The bank may need to offer financial incentives, such as dividend payouts or share buybacks, to reassure investors that it is on the right track. Shareholder support will also be crucial if the bank seeks to raise additional capital through the issuance of new shares or bonds to strengthen its balance sheet. On the other hand, the crisis has prompted many investors to reevaluate their strategies when it comes to investing in the banking sector. In recent years, the financial services industry has attracted significant attention from both domestic and international investors, particularly in India's rapidly growing economy. However, the Indusind Bank crisis serves as a stark reminder of the risks associated with investing in the sector. As a result, Some investors may become more cautious and opt to diversify their portfolios, potentially reducing their exposure to the banking industry. It is also worth considering the broader impact of the crisis on the Indian economy. The banking sector plays a pivotal role in driving economic growth by providing credit to businesses and consumers. Any disruption in the banking sector can have far-reaching consequences, particularly for small and medium-sized enterprises (SMEs) that rely on banks for working capital and financing. If Indusind Bank or other banks in similar situations are unable to fulfill their lending obligations, this could lead to a slowdown in economic activity, job losses, and a reduction in consumer spending. To mitigate these risks, the government may need to step in with additional policy measures. This could involve offering liquidity support to struggling banks, introducing stimulus packages to support businesses, or implementing reforms aimed at strengthening the banking sector's overall stability. The government may also look at accelerating the consolidation process in the banking sector, where smaller, weaker banks are merged with more financially stable institutions, thus creating larger and more resilient entities. This could help address the underlying issues of undercapitalization and poor governance that have plagued some banks in recent years. The crisis at Indusind Bank has also highlighted the importance of financial education and awareness. As the Indian banking system becomes more complex and the number of financial products on offer continues to grow, it is essential that consumers are equipped with the knowledge they need to make informed decisions. Financial literacy initiatives should be promoted, especially in rural and underserved areas, to ensure that individuals are able to navigate the increasingly complex financial landscape. For customers, understanding how banks operate, the risks involved in different financial products, and the importance of diversification can help them make better decisions with regard to saving, investing, and borrowing. Similarly, investors who are considering the stock market or other financial assets should be well versed in how to assess the financial health of companies and the broader macroeconomic trends that may affect market performance. In conclusion, the crisis at Indusind Bank presents both challenges and opportunities for the Indian banking sector. While the immediate focus will be on stabilizing the bank and restoring trust, the longer-term implications of the crisis are far-reaching. By embracing technological innovation, improving governance, diversifying revenue streams, and investing in human resources, Indusind Bank can recover from this crisis and emerge stronger. However, the broader lessons learned from this situation will require systemic changes in India's banking regulatory framework and a greater focus on financial literacy to prevent future crises and ensure the long-term stability of the financial system. To move forward from the crisis, Indusind Bank will also need to focus on strengthening its brand reputation. Reputation management will be crucial, as customer confidence and loyalty are often tied to how a bank is perceived in the public eye. Following a crisis, it is common for customers to feel uncertain or even skeptical about their bank's stability, especially if the financial situation has led to service disruptions or other inconveniences. This is where effective communication comes into play. Indusind Bank must be transparent about the actions it is taking to resolve the crisis and prevent future occurrences. Open and honest communication, whether through press releases, social media, or direct communication with customers, will help reassure clients that the bank is on the right track. Additionally, offering compensation for any losses or difficulties faced by customers during the crisis period could go a long way. In rebuilding trust, beyond communication, the bank could explore customer retention strategies to regain lost customers and attract new ones. Offering promotional interest rates, waiving fees for a period, or providing other incentives could help restore customer confidence and demonstrate the bank's commitment to serving its clients. Furthermore, focusing on enhancing customer service and providing personalized experiences would allow the bank to better connect with its clientele, ensuring that they feel valued and supported. Building a reputation for trustworthiness and financial strength will not happen overnight. It requires a long-term commitment to maintaining high standards of governance, transparency, and customer service. This is why it is essential for the bank's leadership to establish a clear and consistent vision for the future, one that prioritizes ethical practices and sustainability in business operations. In the long term, this will not only help rebuild the bank's reputation but also attract investors, customers, and employees who share similar values. Additionally, Indusind Bank could leverage its corporate social responsibility (CSR) programs to rebuild goodwill in the community. By investing in social initiatives that benefit local communities, such as education, healthcare, or environmental sustainability, the bank can demonstrate that it is dedicated to contributing positively to society. Engaging in CSR activities that align with the bank's values and the needs of the communities it serves could further strengthen its reputation and customer loyalty. As the bank navigates the recovery process, it is important for the leadership to remain focused on maintaining a balanced approach to risk management. While the pursuit of new revenue streams and technological innovations is essential, it is equally important to ensure that the bank remains conservative in its risk-taking behavior, particularly in light of the financial challenges it has faced. By adopting a more cautious and well-calculated approach to risk, the bank can safeguard against future crises and minimize the likelihood of facing similar problems again. The board and senior management must continuously monitor key performance indicators, KPIs, to assess the bank's progress toward recovery. These indicators could include profitability, asset quality, capital adequacy, customer satisfaction, and the performance of newly launched products or services. Regular monitoring will allow the bank to quickly identify any areas of concern and take corrective action before problems escalate. This data-driven approach to decision-making is an essential part of the bank's strategy moving forward. Moreover, the regulatory environment will play a crucial role in the bank's recovery. As a financial institution, Indusind Bank must operate within the guidelines set by India's regulatory authorities, such as the Reserve Bank of India (RBI). The RBI's role in ensuring the stability of the banking system is critical, and any changes in regulatory policies could significantly impact the bank's operations. Therefore, it is essential for Indusind Bank to stay informed about any shifts in the regulatory landscape and adapt its strategies accordingly. One area where regulatory changes could be particularly impactful is in the realm of capital requirements. Following a crisis, the RBI may increase the minimum capital adequacy ratio (CAR) that banks must maintain to ensure their financial stability. For Indusind Bank, meeting these capital requirements may involve raising additional funds through the issuance of new shares or bonds, as previously mentioned. It is also possible that the RBI may introduce more stringent regulations related to lending practices, liquidity management, or stress testing. The bank will need to adapt to these changes while ensuring that it remains competitive in the market. At the same time, the government may introduce new reforms to enhance the overall stability of the banking sector and reduce the risk of future crises. These reforms could include measures to improve governance, increase transparency, and strengthen the oversight of financial institutions. Indusind Bank must stay ahead of these developments and proactively implement any necessary changes to ensure compliance with the evolving regulatory framework. As the crisis recedes and the bank embarks on its recovery journey, one final consideration will be the broader economic environment. The recovery of Indusind Bank is closely tied to the overall health of the Indian economy. As India continues to recover from the economic challenges caused by the COVID-19 pandemic and other global factors, the performance of the banking sector will also improve. However, the bank will need to remain agile and adaptable to changing market conditions. Economic factors such as inflation, interest rates, and global trade will all have a direct impact on the bank's performance, and it is crucial for the bank to be prepared for any fluctuations. In conclusion, while the crisis faced by Indusind Bank is undoubtedly a significant setback, it presents an opportunity for the bank to reassess its strategy, make necessary changes, and emerge stronger than before. By focusing on strengthening governance, improving customer service, diversifying revenue streams, embracing technology, and rebuilding its reputation, the bank can successfully navigate its way out of this crisis and set itself on a path to long-term growth and success. However, it will take time, effort, and a sustained commitment to excellence to fully recover. Indusind Bank's ability to learn from this experience and make the right decisions in the coming years will determine its future trajectory and the impact it will have on the Indian banking sector. As Indusind Bank works toward rebuilding its financial health and reputation, another key element to focus on will be its relationship with external stakeholders, such as regulators, investors, and customers. Engaging with these stakeholders will help foster trust, transparency, and accountability, which are vital for the bank's recovery. The way the bank communicates with and listens to its customers, investors, and regulatory bodies will shape its recovery trajectory. One important step in this regard is improving relationships with investors. Shareholder confidence has been shaken by the crisis, and rebuilding it will require a strategic and well-executed investor relations plan. The bank will need to provide regular updates on its recovery efforts, financial performance, and future outlook to reassure its investors. Clear communication of the steps taken to resolve the issues will be crucial. If the bank can successfully regain investor trust, it may even be able to secure additional capital, which could bolster its financial position and enable it to weather future challenges. Building stronger relationships with investors also means addressing their concerns and providing them with clear strategies for managing risk. Indusind Bank should create a roadmap for risk management that emphasizes the importance of a diversified portfolio, prudent lending practices, and strict adherence to regulatory guidelines. By adopting a more conservative and transparent approach to risk, the bank can assure investors that it is taking the necessary steps to prevent a recurrence of the crisis and is positioning itself for long-term growth. On the customer front, restoring customer loyalty will be equally important. Many customers, particularly those who have experienced service disruptions or financial difficulties as a result of the crisis, may have lost trust in the bank. To win back customer confidence, the bank will need to deliver exceptional service and engage in outreach efforts to address concerns and build stronger relationships. The bank can implement targeted campaigns aimed at re-engaging with its customers. Personalized offers, such as reduced fees, attractive loan terms, or special savings accounts, could be a way to regain customers' trust. Additionally, improving the bank's overall customer service experience is crucial. A customer-centric approach, with timely responses, helpful advice, and seamless transactions, will go a long way in rebuilding a loyal customer base. Customer education is another key element that Indusind Bank can focus on to enhance its relationship with clients. Many banking customers are not fully aware of the range of financial products and services available to them. By offering educational resources, whether through webinars, in-branch workshops, or digital content, the bank can empower its customers to make informed financial decisions. Financial literacy programs could be particularly beneficial, especially in rural or underserved regions where access to financial knowledge may be limited. Empowered customers are more likely to remain loyal to the bank and trust its services. Regulatory authorities will continue to play a significant role in shaping the bank's recovery. Indusind Bank must maintain a proactive and cooperative relationship with regulatory bodies like the Reserve Bank of India (RBI) and the Securities and Exchange Board of India (SEBI). These authorities provide crucial guidance and oversight, and maintaining transparency and compliance with their requirements is essential for ensuring the bank's stability. The RBI, for example, may implement additional measures to ensure that the bank meets all regulatory requirements, such as capital adequacy and liquidity ratios, and that its internal controls are operating effectively. Indusind Bank will need to work closely with the RBI to demonstrate its commitment to regulatory compliance and governance best practices. This collaboration will also help the bank avoid any potential penalties or restrictions that could further hinder its recovery. As the bank seeks to stabilize and expand its operations, a key area of focus will be digital transformation. The banking sector has been undergoing a technological revolution, with many institutions embracing digital banking solutions to enhance customer experience, increase operational efficiency, and offer new services. Indusind Bank must continue to invest in its digital infrastructure to stay competitive in the market. The bank should prioritize the development of a user-friendly mobile banking platform that caters to the growing number of customers who prefer digital channels. The mobile app should include easy-to-use features like mobile payments, peer-to-peer transfers, instant loan applications, and account management. With the right investments in technology, Indusind Bank can not only improve the customer experience but also reduce operational costs and increase its reach. Blockchain technology and fintech partnerships can also play an important role in the bank's digital transformation. Blockchain has the potential to streamline many processes in the banking sector, including cross-border payments, clearing and settlement, and identity verification. By exploring the use of blockchain for more secure and efficient transactions, Indusind Bank could reduce fraud and improve its overall service offering. Additionally, collaboration with fintech companies could enable the bank to develop new products and services that cater to the evolving needs of customers. Whether through digital lending platforms, robo-advisory services, or innovative payment solutions, partnerships with fintech startups can help the bank expand its product portfolio and reach new market segments. The importance of cybersecurity will also be heightened as the bank moves forward with its digital transformation. As more financial transactions occur online, the risks associated with cyberattacks and data breaches increase. Indusind Bank will need to invest in state-of-the-art cybersecurity infrastructure to protect both its internal systems and customer data. Strengthening its digital defenses will not only reduce the risk of fraud and data breaches but will also improve customer confidence in the bank's ability to protect their sensitive information. Further, sustainability and environmental, social, and governance (ESG) factors should be integrated into the bank's recovery strategy. In today's financial landscape, stakeholders, including customers, investors, and regulators, are increasingly placing importance on sustainability and ethical business practices. Indusind Bank can differentiate itself by embedding ESG principles into its operations and business model. This includes reducing its carbon footprint, promoting financial inclusion, and ensuring responsible lending practices. By integrating ESG criteria into its strategy, the bank can appeal to socially conscious investors and customers, who are increasingly seeking businesses that align with their values. Moreover, maintaining a strong commitment to corporate social responsibility (CSR) initiatives can also enhance the bank's brand reputation and demonstrate its dedication to the broader community. The bank must also keep an eye on macroeconomic trends and global financial developments. Indusind Bank's performance is not isolated from broader economic factors, and it must remain vigilant about changes in the economic landscape. Fluctuations in interest rates, inflation, currency exchange rates, and global trade will all influence the bank's business environment. The bank must be prepared to adapt its strategy based on these external factors to remain competitive and safeguard its interests. For example, as interest rates fluctuate, the bank's loan portfolio and interest income will be directly affected. Rising rates could dampen demand for loans, while falling rates could increase the volume of credit extended. Similarly, global economic conditions, such as the health of India's major trading partners, could impact the bank's foreign exchange operations and international business activities. Indusind Bank must continuously assess these global trends and adjust its business strategies to mitigate potential risks and capitalize on new opportunities. In conclusion, the road to recovery for Indusind Bank is a multifaceted and long-term process that will require the bank to address several critical areas, including financial health, governance, customer relationships, digital transformation, and regulatory compliance. By implementing a strategic and well-rounded recovery plan that focuses on strengthening its core operations, rebuilding its reputation, and embracing innovation, the bank can emerge stronger from this crisis and position itself for future growth. While the road ahead may be challenging, the crisis also presents an opportunity for Indusind Bank to reevaluate its business model, improve its governance practices, and become more resilient in the face of future challenges. With a clear vision, a customer-centric approach, and a commitment to ethical practices, Indusind Bank can not only recover but thrive in an increasingly competitive and dynamic financial sector. The bank's ability to adapt and innovate in response to the changing needs of customers and the evolving economic environment will determine its success in the years to come.